Welcome back to Investing Talk Podcast. Today, we are zeroing in on a company that's trying to really shake up the operating room. Vicarious Surgical. They're working on some pretty cutting-edge surgical robotics. Well, our mission today is to explore the sources around their latest corporate moves, their financial health, and, the market catalysts. All to answer that big question, is now actually a good time to buy? And hey, as we get into all this complex info, we really want to make sure we're covering the stocks you care about. We want to bring you the insights you actually need. So if you're listening, please make sure you hit subscribe, maybe give us a like, and definitely leave a comment below. Oh, and if there's a specific company you want us to analyze, just drop the name in the comments. Seriously, we read every single one. Okay, let's unpack this then. Looking back, say, the last 3 months, the sources really paint a picture of some intense corporate activity. This doesn't feel like just standard operational stuff. It almost seems like management was, executing an emergency overhaul while scrambling for cash. It feels incredibly fast-paced for a company in this, med tech space.
That's a really key distinction, actually. The past quarter wasn't about growth, not at all. It was much more about survival and resetting the runway, so to speak. For any pre-commercial medtech firm, just securing that next bit of capital and getting the leadership aligned, well, those are existential steps. And what's kind of fascinating here is how deliberate these maneuvers seem, even when they're clearly under financial pressure.
Okay, so let's start with the money moves. Just last month, October 2025, they announced the pricing of a $5.9 million registered direct offering. Maybe we should slow down here for a second. For listeners who aren't tracking these kinds of placements daily, why is a registered direct offering with shares and warrants? Why is that significant compared to just, selling plain old equity?
Yeah, that's crucial context. So a registered direct offering basically means they're selling securities directly to a select group of institutional buyers. They kind of bypass the open market volatility. It's often faster, cleaner for smaller capital amounts. But the key element here, like you said, is the inclusion of warrants.
Which are essentially options, right? Giving the right to buy later.
Precisely. Warrants are basically a sweetener attached to the shares. They give the buyer the right, not the obligation, but the right to purchase more shares later at a specific preset price. And this is vital because it kind of addresses two needs at once. It gives them that immediate short-term capital right now.
To fund operations.
Exactly, to keep the lights on. But it also sets up a mechanism for future funding down the line. The exercise of those warrants later provides more capital without needing another potentially expensive and time-consuming equity raise right away. It gives management some breathing room, some flexibility for the next few quarters.
Okay, so it raises some capital management questions, sure, but they weren't just fixing the bank account, were they? They were also tinkering with the leadership structure.
They absolutely were, which suggests they really recognize the scope of the challenge ahead. In September 2025, they brought in Joseph Doherty as chairman of the board. And this isn't a minor move. Doherty has some serious experience from major surgical players. Think Olympus, Johnson & Johnson.
Heavy hitters.
Right. Bringing in that kind of established governance and, frankly, operational insight signals they're serious about sharpening their strategic direction, moving away from just pure R&D and more towards, commercial viability.
But hang on, does bringing in a corporate veteran from a huge established place like Olympus, doesn't that risk maybe stifling the innovative spirit, the very thing that's supposed to make Vicarious unique? Is this about stabilizing or is it about standardizing, maybe making them less nimble?
That's a fair question, and the market is certainly watching that tension play out. But the sources seem to suggest this signals more of a strategic pivot towards execution. Innovation gets you the cool product, sure, but commercialization, that needs robust supply chains, regulatory know-how, partnerships.
Stuff Doherty knows.
Exactly, areas where his experience is invaluable. The goal seems to be installing the necessary guardrails to transition from, let's say, a startup idea factory to a functioning medical device company that can actually sell things.
Right, and we can't talk about transitions without facing the financial realities that probably force some of these moves. Let's look back at August, Q2 2025 financials release.
Yeah, that August report. That seems to be the catalyst for a lot of this urgency. They reported a non-GAAP net loss of $13.3 million. Now, non-GAAP, simply put, is their operating loss minus certain non-cash expenses, but the bottom line, they're burning cash fast. And critically, cash on hand was only $24 million.
Okay.
And their cash burn guidance for the full fiscal year 2025 was set at approximately $50 million.
Whoa. Okay, that ratio is terrifying. $50 million projected burn against a starting pot of $24 million. Even adding the subsequent $5.9 million raise, that's an extremely short runway. That feels like crisis level.
It absolutely is, make no mistake. And that financial reality check, I think, is what really drove those leadership shifts back in August, too. You had Adam Sachs become president and Stephen Frum appointed as CEO. When you see changes right at the type like that, following such alarming burn rates, it really signals a strong, deliberate focus on operational efficiency. They're clearly trying to move out of pure R&D mode and into hyper-focused execution mode, and the clock is definitely ticking towards that cash runway limit.
Okay, so we've covered the emergency maneuvers of the last few months. Now let's look ahead. This is where it gets really interesting, I think. Now that the foundation has been maybe desperately rebuilt, what are the confirmed near-term catalysts, things actually scheduled over the next quarter that could really move the share price?
Okay, yeah, we have several hard dates investors really need to circle on their calendars. The very first one is actually October 17th, 2025. That's when they finalize the settlement of that $5.9 million direct offering we talked about. That's more of an immediate, maybe minor inflection point. Just confirming the cash is officially in the bank.
Got it. Confirmation.
But the real moment of truth, I'd say, is November 14th. That's the Q3 2025 earnings release and the conference call. The sources really emphasize this is the critical update. Investors are going to be laser focused on two main things. First, the cash runway. Did they manage to extend it somehow? What's the new burn rate projection look like?
Makes sense.
And second, any concrete, measurable progress towards regulatory milestones or, definitive product deployment timelines, that management team needs to show they're making that projected $50 million burn stretch much, much farther.
And beyond the company's own news, we also have these broader market forces coming into play in November, December, things that can create volatility just based on institutional flows, right?
That's exactly right. Around November 25th, you've got the major ETF quarterly rebalancing. Basically, funds that track indices, they have to adjust their holdings periodically. So if Vicarious Surgical gets removed from an index or maybe added to one, that can force mass selling or buying completely regardless of company news.
Just mechanical trading.
Pretty much. Then on December 1st, the institutional ownership report, the 13F filings, get released.
Okay, explain the 13F filing again. What does that actually tell us, and why does it drive perceptions so much for a smaller company like this?
So a 13F is a form filed quarterly by large institutional investors, think hedge funds, mutual funds, pension funds, that kind of thing, showing what U.S. stocks they owned at the end of the quarter. When that December 1st report comes out, investors comb through it to see if high-profile, supposedly sophisticated funds have bought into Vicarious Surgical or maybe sold out. For a small-cap, pre-commercial firm like this, institutional confidence is, well, it's almost everything. If a significant, respected hedge fund takes a new stake, it can really validate the technology in the market's eyes and seriously shape the broader perception of their medium-term outlook.
Right. And speaking of confidence, or maybe just hope, the sources also mentioned some speculative wildcards, things that aren't scheduled but could send the stock flying if they actually happened.
Yeah, the rumors mostly center around two things: validating the technology faster or solving the capital crunch permanently. One key rumor is the possibility of strategic partnership talks, or even acquisition talks, given how hot the robotic space is. Observers speculate that maybe a major medtech firm, perhaps one looking to leapfrog the current multi-port systems, might approach Vicarious to secure that unique single-port platform they're developing.
That would be huge.
Massive. And that ties into the second rumor: speculation about accelerated regulatory pathways. If their early feasibility studies, for example, show truly exceptional results, maybe faster patient recovery, way less invasiveness, there's some chatter that it could open the door to, say, expedited FDA feedback, that kind of news could pull their whole commercial timeline forward dramatically. And it would instantly justify their current high burn rate.
Okay, that brings us nicely to part 3 then. Moving away from these specific events and looking more at the underlying fundamentals. They've got big ideas, sure, and some serious financial hurdles. But what does the balance sheet actually look like right now? And what is their true competitive advantage, the thing they're betting the farm on?
Right, let's start with the basics. Revenue status. Currently, there's zero available data on current revenue growth because there isn't any. The entire focus, pretty much every dollar spent, is on developing and eventually selling that single-port surgical robot. So right now, they are purely in the capital expenditure phase. deep in it.
Spending money, not making it yet.
Exactly. And the earnings projections really reflect this massive investment. Analysts are forecasting a significant negative EPS for 2025. The range is pretty wide, actually, from roughly negative $9.45 down to $8.17 per share. This just confirms that intense need for the new management team to find operational efficiencies. They are absolutely in a race to shrink those losses before the cash well runs dry.
And when we put those losses up against the company's actual valuation, the picture becomes, well, very clear about the risk involved here.
Precisely. The financials show a current market cap of only about $39.7 million. That is really low for a company aiming for this kind of disruption in surgery. Even more telling maybe is the trailing 12 months, the TTM net income. It stands at negative $59.63 million.
Wow.
Yeah. So we're talking about a company that lost significantly more money last year than its entire current market valuation. This isn't just a high-risk stock. It's a very high-stakes bet on innovation succeeding and succeeding incredibly fast.
Okay, despite those really challenging numbers, they must have something compelling, a strong competitive edge to justify this level of risk and to attract that capital they just raised. We keep hearing about this single-port surgical robot. What specific problem does this solve better than, say, the existing giants like Intuitive Surgical with their multi-port systems?
This really is the entire investment thesis boiled down, isn't it? Existing robotic surgery, the kind most people think of, typically requires multiple small incisions, one for the camera, others for various instruments. Vicarious is developing a system that aims to do complex procedures through just one single small entry point.
Just one cup.
That's the goal. The technology uses these humanoid-like robotic hands and arms that can articulate very sharply once inside the abdomen. They're designed to replicate complex human hand movements, but all through that tiny single incision. The potential clinical advantage is pretty significant. Smaller incisions could mean less scarring, potentially faster patient recovery times, maybe reduced risk of certain complications tied to multiple entry points. If, and it's still an if, but if they can achieve similar surgical complexity with vastly reduced trauma, well, that gives them a truly unique selling proposition in a growing healthcare equipment sector. That's the long-term value proposition, keeping that institutional interest alive, despite the current financials.
Okay, that explains the potential upside. But that brings us squarely to the risks. What are the main risk factors the sources highlight that could derail that innovative promise?
Yeah, the risks are pretty clearly laid out. First, competition, obviously.
Yeah.
They aren't operating in a vacuum. Developing cool tech is one thing. Winning market share against entrenched giants with deep pockets and existing hospital relationships, that's a whole different battle.
A big one.
Huge. Second, those persistently high operational costs we keep mentioning, management has to navigate that expertly to stretch the cash runway until they can actually start selling things and generating revenue. And the third set of risks is maybe broader, just general market volatility affecting funding, and crucially, any potential regulatory changes or unforeseen delays in the FDA approval process. That's always a big overhang for medtech.
Okay, so given all that, the emergency maneuvers, the high stakes, the potential payoff versus the clear risks, what does this volatility look like when we move from the C-suite calendar to the actual technical charts? Let's pivot now to the technical view. For you, the listener, trying to maybe decide on an investment action here, what do the technical signals and the analyst ratings suggest about the current valuation?
Well, what's really interesting here is the stark contrast sometimes between the near-term technical picture and the longer-term fundamental forecast. Analysts, based on current technicals, seem to expect some near-term price decline. They're projecting a trading range in the coming months somewhere between, say, $4.72 and $5.26. That clearly reflects the pressure from the recent capital raise and the uncertainty heading into that Q3 review.
A near-term weakness expected.
But the long-term forecasts, they are dramatically more bullish. Some predict potential growth way up to $13.85, but that's by 2030. And it's driven entirely by the assumption of successful product development and significant market expansion down the road.
So definitely short-term caution seems warranted based on the charts.
Yeah.
What are the momentum indicators saying right now? Are we looking at maybe finding a floor soon, or could this drop continue?
The technical setup right now screams caution, really. The moving averages just recently flashed a sell signal, which reflects that recent downward price action. The technical trends would need a pretty significant positive catalyst, like surprisingly good Q3 news or a confirmed partnership announcement to actually turn bullish from here. Right now, the relative strength index, the RSI, it's pretty neutral, sitting around 38.02, and the MCD indicator is slightly negative. It just paints a picture of cautious trading conditions overall. The market seems to be waiting for a definitive signal, a break in either direction.
Okay. And what about the professionals? What's the analyst sentiment? Buy, sell, hold?
Currently, the stock holds a consensus hold rating from analysts,
Hmm.
which honestly feels appropriate given the very high risk-reward profile we've been discussing. They have a consensus 12-month price target around $7. So that implies significant upside if they execute flawlessly, but it also clearly reflects the immense uncertainty surrounding the company right now.
Okay, so tying this all together, connecting that financial desperation we saw with the technological promise, what's the overall investment thesis that the source material seems to conclude with?
Well, the overall thesis is that this is really a classic high-risk, high-reward proposition. It's not for the faint of heart. The source material assigns an overall bullish rating of 7.5 out of 10, which might seem high given the immediate financial hurdles. But the rationale is built entirely on that strong long-term growth potential and the potentially revolutionary nature of their single port technology.
Right.
The stock is kind of viewed as potentially attractive for two very different types of investors. You've got the short-term traders, maybe looking to leverage those upcoming catalysts we talked about, specifically the Q3 earnings or those partnership rumors, playing the volatility. And then you have the long-term investors, the ones banking on the structural disruptive advantages in the surgical robotics field playing out over years. The major caution flag wave throughout, however, remains that short-term volatility and the absolute requirement for near-flawless execution from this new leadership team. They have very little room for error.
That sums up the picture perfectly, I think. The short-term trajectory for Vicarious Surgical looks like it will be driven primarily by, well, capital management, how well that new leadership team executes, and whether the market starts to gain confidence that they can actually turn clinical progress into real commercial milestones. Those strategic partnerships and maybe positive institutional flows showing up in the 13Fs, those remain the most influential wildcards, shaping both the near-term bumps and the long-term value potential. So here's a final thought for you, the listener, to maybe mull over as you prepare for those November earnings. We learned that the reported FY 2025 cash burn guidance is roughly $50 million, against a starting cash position now of maybe around $30 million after the recent raise. That's still tight. So when that Q3 earnings report drops in November, what specific, maybe non-financial progress, beyond just reporting the cash left, what will you look for? What would prove to you that management is truly succeeding in extending that cash runway and mitigating the huge financial risk inherent in any pre-commercial firm like this? Will it be, say, a new C-suite hire focused solely on commercialization? Or maybe a specific concrete date announced for a key regulatory filing, something tangible? That's it for this exploration. Thank you for joining us, and we look forward to the next one.